Welcome to the Deep Dive from Talk Tickers.
Hello.
Today we're really digging into the recent Q3 2025 earnings call for Corning Incorporated. That's ticker GLW.
Yeah, and it was quite a ride if you were watching the market action around the call.
Exactly. I mean, you saw these significant beats, guidance raised. Normally, that's straightforward good news.
But the stock saw some pretty intense volatility initially, right? Before that big rebound.
Total whiplash.
Yeah.
So our mission today is to figure out, what management actually said that drove the underlying success and what spooked investors, at least temporarily.
Right. There was definitely confidence from management about the long-term picture, but a very specific issue seemed to hit the headlines first. We need to unpack both sides.
Okay, let's start with the hard numbers then, the results. Because the performance itself looked, pretty outstanding. What did they report on that core non-GAAP basis?
Yeah, the results were definitively strong. Core sales came in at $4.27 billion.
Okay.
That's a solid 14% increase year over year, and it did beat the consensus estimates.
And earnings per share.
Same story there. Core EPS reported at $7.67. That's up 24% year over year, also beating consensus.
Those are definitely impressive growth rates, but growth is one thing, profitable growth is another. What about efficiency? Margins?
Right. And that's where their Springboard plan seems to be really delivering. Their core operating margin expanded by 130 basis points year over year.
So 1.3 percentage points.
Exactly. Pushing it up to 19.6%. You can really see that as the payoff from their strategic actions.
And return on investment. That's always key.
Absolutely. Core return on invested capital, ROIC, hit 13.4%. I mean, that figure really tells you they're converting capital into profit very efficiently. It's a hallmark of a quality operation.
Okay, so on paper, it looks like a classic beat and raise. Great numbers. Yet the stock tanks pre-market before roaring back to a new 52-week high the next day. It just highlights that complexity, doesn't it?
Yeah.
The long-term plan seems to be working, but investors are clearly wrestling with some near-term noise.
Definitely noise. But setting that aside for a moment, we have to talk about the foundation here, which is that Springboard plan. Management kept highlighting record core sales and core EPS because of it.
Now, are we sure this is more than just, clever branding for standard cost cutting? Is the market seeing real sustainable improvement?
Well, the data points towards something more structural, I think. Since they launched Springboard back in late 2023, core EPS has grown 72%.
72%.
Yeah. And crucially, that's more than double the rate of sales growth over the same period.
Okay. So profitability is outpacing revenue growth significantly.
Right. That kind of leverage suggests it's more than just trimming fat. It points to fundamental improvements in their cost structure and operational efficiency, not something you see everywhere.
And clearly, that success is breeding confidence internally about the outlook.
It really has. They actually pulled forward their big target. Management now expects to hit their ambitious 20% core operating margin goal in Q4 2025.
Wait, Q4 25? That's a full year ahead of their original schedule, isn't it?
A full year ahead, yeah. And achieving that kind of margin profile fundamentally changes the investment story, the valuation discussion.
Okay, so that explains the guidance raise for Q4 then.
Exactly. Q4 core sales guidance is now around $4.35 billion, and core EPS is expected between $0.68 and 72 cents. Both of those are above what the street was looking for.
Any caveats in that guidance?
Just a small one they called out. There's a temporary, maybe 3-cent impact baked into that EPS range, specifically tied to the costs of ramping up their new solar manufacturing capacity. But overall, very strong guidance.
All right, let's pivot to what's actually driving this acceleration,
Yeah.
growth engines.
Yeah.
And you really have to start with optical communications, right? The whole AI and hyperscale data center boom.
Yeah, this is where the narrative really shifts, I think. It's moving beyond just a turnaround story with Springboard.
Into more of a self-funding growth cycle.
Exactly.
Right.
Powered by these huge secular trends like AI connectivity.
And the numbers inside optics are pretty staggering. Look at the enterprise sales component. That's the fiber used inside the data centers, connecting all those GPUs.
Right.
That grew 58% year over year. 58%. Driven, they said, by new products specifically designed for these dense Gen AI clusters.
And think about the scale. The annualized run rate for that enterprise business is now $3.3 billion.
Wow.
That's up $2 billion just since 2023. It's just explosive growth in that specific area.
And that seems to be setting up what they call the scale-up opportunity. which sounded even bigger.
Yeah, the scale, it's fascinating. It basically comes down to physics. As these AI systems get larger and the connections inside them get longer and faster,
It just can't keep up.
pretty much, you hit what they call the electrical to optical frontier line. Beyond a certain speed and distance, copper wiring becomes too lossy, too noisy, maybe even generates too much heat. You have to switch to optical fiber.
And they mentioned a single large AI node today might already have, over 2 miles of copper inside it?
That's the figure they used, 2 miles. So imagine when those miles start flipping over to fiber as the systems scale up. It's a huge potential conversion.
How big? Did they quantify it?
They suggested this scale-up opportunity could eventually be 2 to 3 times the size of their current enterprise business, which is already running at $3.3 billion a year.
Okay, 2 to 3 times, $3.3 billion. That is a massive potential. No wonder investors are focused here.
Absolutely. But they aren't just focused inside the data center. They're also looking at the connections between data centers, DCI, data center interconnect.
Right. What's the innovation there?
They've developed new high-density Gen AI fiber. The key benefit is it lets customers pack 2 to 4 times more fiber strands into the existing underground conduit.
So it avoids having to dig new trenches, which is hugely expensive and time-consuming.
Exactly. It solves a major bottleneck for data center expansion. And they put a number on that too, projecting this DCI business could be a $1 billion opportunity by the end of the decade.
And specifically mentioned working with Microsoft on this.
Yeah, a collaboration to speed up production of something called hollow core fiber. The idea is light travels faster through air than glass, so for certain super low latency connections, like in Azure's AI workloads, this hollow core fiber offers an advantage.
Interesting. Okay, so that's optics. Huge AI driver. What about the other engines? Specialty materials.
Right, moving on. Specialty materials, think premium glass for smartphones, watches, things like that. Sales there were up 13% year over year.
Okay, solid.
But the net income in that segment was up 57% year over year.
Wow, huge margin expansion there too. Why?
Driven by innovations in their premium glass, timed with flagship product launches from major customers.
And speaking of major customers, Apple. There was big news there.
Huge news. Apple announced a new $2.5 billion commitment to Corning.
$2.5 billion.
Yes. It specifically establishes their facility in Harrodsburg, Kentucky, as the home for 100% U.S.-made cover glass for iPhones and Apple Watches.
Okay, reshoring domestic supply chain. That fits the current theme.
But it's more than just manufacturing. They're also opening a new co-innovation center together right there in Kentucky. Management used the phrase significantly larger, longer-term spring. It really locks in that premium relationship for years to come.
Got it. Okay, third engine, solar. This seemed tied into that domestic manufacturing strategy as well.
Very much so. They're ramping up a new facility in Hemlock, Michigan, right now in Q4, specifically for producing solar ingots and wafers domestically.
Yeah, and the goal there?
It's ambitious. Build this into a $2.5 billion revenue stream by 2028.
Okay, $2.5 billion by 2028. That's a big target. How likely is that?
Well, here's the crucial part. They stated that over 80% of the planned capacity from that facility is already committed under long-term agreements for the next 5 years.
80% is committed already.
For 5 years. So a lot of the execution risk, the will they find customers risk, is significantly reduced. It's largely pre-sold.
Okay, so let's recap the positive story then. Springboard plan working, margins expanding ahead of schedule. Optical exploding thanks to AI, both inside and between data centers. Huge locked-in commitments from Apple, and for the new solar business, it sounds almost perfect.
Almost.
Which brings us back to that initial stock drop. If the core story is this strong, what caused that panic? What's the critical tension here?
The main pain point, the reason for the initial negative reaction, seems localized to their traditional optical communication sales, specifically related to China. It fell short of some external estimates.
Okay. The China factor, what happened?
Well, the big news was that China imposed a pretty substantial anti-dumping tariff, 37.9% on optical fiber imported from the U.S., and that includes Corning's products.
37.9%.
Ouch, yeah. That, combined with what they described as generally softer network investment trends within China right now, is expected to be a headwind. It'll likely weigh on their orders and maybe pricing specifically in that region in the near term.
So it's a regional, politically charged issue impacting one part of one segment.
Correct. And that seems to be what spooked the market initially.
But it creates this fascinating disconnect, doesn't it? The stock drops because of perceived demand weakness linked to China tariffs.
Right.
Yet management is simultaneously saying Their global problem, especially in the AI-related parts of optics, is that they literally can't make the stuff fast enough to meet demand.
That is the core tension right there. Management was very clear. Global demand for their advanced optical products, particularly those tied to AI, is actually outstripping their current supply capacity.
Did they give specifics on
But
that?
CEO basically said, if I could put more on my loading dock, our customers would take more. He talked about ongoing dialogues with customers, not about negotiating price, but about how customers can help them. Corning de-risk the investments needed to build out more capacity faster.
So customers want more product faster and are potentially willing to help make that happen.
Yeah.
The bottleneck isn't demand, it's supply ramp up.
Exactly. That seems to be the situation for the high growth areas. The China tariff is a specific, localized headwind on the more traditional side.
Okay, so putting this all together in the broader investor context, how should we think about this strategic contradiction?
Well, I think the big picture is that the strategic shift is basically complete now. They've successfully navigated the Springboard turnaround phase.
And now they're firmly in a growth cycle.
Self-funding growth cycle, yeah. Fueled by AI, by premium device materials via Apple, and by this de-risked solar build-out. And you see that confidence reflected in how they talk about using their cash.
Right. Capital allocation. What's the priority?
Priority one is funding that high return organic growth, building out that capacity we just talked about.
Makes sense.
They also emphasize maintaining a really strong balance sheet. Their average debt maturity is out at 21 years, which gives them huge flexibility.
Very comfortable position.
And then for returning excess cash to shareholders, the primary tool remains share buybacks. They committed to continuing that buyback program every quarter. That's usually a strong signal of management's belief in the long-term value.
Okay, got it. Which brings us smoothly to our not financial advice segment.
Ah, yes, the important disclaimer part.
Absolutely. Standard disclaimer applies. This is purely for discussion and entertainment. We are not investment advisors. This is not a recommendation to buy or sell anything. Please do your own research.
Duly noted. Proceed with the outrageous but plausible.
All right. So based purely on the dynamics we discussed from the call specifically, that stark contrast between the strong locked-in growth drivers, AI, Apple, solar, and that very specific immediate China tariff risk. Here's an idea.
Okay, let's hear it.
A relative value along short trade. You go long GLW. You're betting on that clear path to 20% margins, the massive scale-up potential in AI optics, the locked-in Apple and solar revenue. Basically, you're long the core success story.
Okay, long GLW. Makes
Yeah.
sense. What's the hedge?
The hedge is designed to neutralize that specific risk that caused the initial market jitters. You place a short position, perhaps against a basket of other U.S.-based optical fiber companies that are maybe less diversified than Corning, more exposed to general fiber pricing or that tariff directly.
Interesting. Or maybe even structure the short to try and isolate just the expected near-term revenue impact from the China tariff on Corning's own optical segment.
Exactly. The goal is to hedge out, or at least dampen, that specific, known, politically driven downside risk from the tariff and the softer China investment climate.
So you're effectively trying to isolate your exposure to Corning's other massive growth engines, the AI scale-up, the Apple partnership, the solar build-out, while minimizing the impact of the one major headwind everyone is currently focused on.
Precisely. It's a way to play the core strength while acknowledging and hedging the known risk factor. Outrageous maybe, but plausible given the call's narrative.
It's a thoughtful structure, definitely plays on that core tension we identified. Okay, so let's wrap up with the essential takeaways for listeners. What are the key nuggets?
All right, nugget one. The Springboard plan is working, and working ahead of schedule. That 20% core operating margin target is now expected in Q4, a year early. That's huge.
Nugget two. Gen AI is driving explosive growth in optical communications, especially enterprise sales inside the data center, up 58% year over year. And the scale-up opportunity there looks massive.
Nugget three. Major long-term strategic commitments are de-risking future revenue streams.
Yeah.
The $2.5 billion Apple deal for U.S. glass production and co-innovation, and the $2.5 billion solar target with 80% capacity already committed for 5 years.
And the critical tension remains. All this strong core growth and raised guidance is bumping up against that specific headwind in optical comms from the China tariff and softer regional investment. That's the friction point that caused the volatility.
Right. And finally, here's that provocative thought for you, the listener, to mull over. We talk about the huge Apple commitment, the $2.5 billion, the U.S. manufacturing, the Co-Innovation Center. Should investors start thinking about whether this deep collaboration could lead to more Corning content per device in the future? Could the next generation of specialty glass innovations actually increase the value Corning captures from each iPhone or watch sold, potentially accelerating their profitability even faster than models currently predict?
That's a really interesting angle. The more Corning per device thesis gaining strength through co-innovation. Excellent food for thought.
Definitely something to watch. That concludes our deep dive into the Corning Q3 2025 earnings call. As always, we encourage you to continue your own research. Thanks for tuning in to Talk Tickers.